out of nowhere for a few people, as you said it, but I think it has been grounded into Wall Street for the last 10 years.
I guess as you look forward to kind of how this grows and how this scales, push back on the critics who say Canton is not as decentralized as ETH, not core crypto ethos being displayed here. What's kind of the pushback on those criticisms?
Well, I would say the list of names that you just dropped is what I would call the moat.
Today's episode is sponsored by Brave. Brave blocks ads and trackers on it, and time to switch to Brave. Well, one of the biggest trends in 2025 spilling over and accelerating in 2026 as institutions come on chain, and perhaps one project that for some of our viewers may have come out of nowhere, but certainly not in the wider world of everything happening in the institutionalization of crypto, is Canton Network, nominated for Crypto Project of the Year, and super excited to have on Coinage with us today the General Director at the Canton Foundation and co-founder of Fairmint, Joris Delanu, joining us here. Joris, good to see you, man.
Hey, hi. Yeah, pleasure to be here.
This is a hot one because I don't know. Generally, right now, there's a lot of excitement what's going on in Canton, but for people who may have been heads down, focused on ETH, Solana, maybe not as familiar with Canton. So excited to chat with you today, Joris. And maybe we just start from a high levels principles, because as I mentioned, you're also the co-founder of Fairmint, working on bringing equities on chain, cap tables on chain. Why don't we just talk about what makes Canton different, perhaps for those who haven't heard of it? What's the big picture?
Well, yeah, Canton came out of nowhere for a few people, as you said it, but I think it has been grounded into Wall Street for the last 10 years with a team of people, expert in this industry, building this whole infrastructure for the last 10 years. They come from digital asset, they come from DRW, they come from all these like pretty known companies in the industry, and rather than to follow the hype of all the public chain over the last 10 years, they simply worked on use cases. And I think that right now, what we see is really like a wheel from a lot of the institutionals to move on chain, but with their own checklist. And I think Canton is answering like most of the requests of those institutionals. And that's exciting. And for the just the clarity, like I got elected to represent the small members in the ecosystem of Canton, and to make sure that they have their voice heard in the board, and to make sure that whatever is built, we have the right level of balance between precisely what is done and pushed by the big players, and what can be done by all those teams over the world that are pushing the boundaries, bringing DeFi to what we knew as TradFi before.
Yeah, no, I think it's an interesting, I guess, we framed Crypto Project of the Year as a bunch of different projects that are nominated, and obviously there are differing, shall we say, psychologies and principles across the board. And it's a sliding scale in terms of what really matters in terms of decentralization. I think it's important to note when we just kind of frame up what you're talking about there in terms of bringing together all kinds of different interests in what Canton's trying to execute. There's the idea of Ethereum and really leaning into decentralization. For Canton too, though, it's kind of a who's who of Wall Street. I just want to kind of read a few of the names attached to it, because you got Goldman Sachs, BNP Paribas, you got TradeWeb, you got NASDAQ, BNY Mellon. The list goes on. Citadel. I mean, when it comes to kind of what the difference is when you compare and contrast Ethereum, since I know, in your background in building Fairmint, you've looked at all the ecosystems. What do you think is the fairest things you've heard about Canton, and maybe the least fair?
People come to us and their teeth are so bad that they all need to be extracted. They all need to be taken out, and they need to get.
Well, I would say the list of names that you just dropped is what I would call the moat, because a lot of other ecosystem would have loved to convince this type of companies, projects, teams, or big names to participate in their ecosystem. So we should all agree that building this is already pretty big and significant. And the fact that everyone is on top of that now actively working on the chain, making sure that they switch from a proof of concept to production is also something that I think should be more acknowledged. And so maybe that's the least fairest point that I've been hearing these days. Like this is out of nowhere, and it's not really active and all. Like I can tell you every week we have like 80, 90 people of the community on the same call trying to work on what are the tokenomics, on the accountability as well, checking milestones. So I think we should all highlight that a little bit more, because not a lot of ecosystem have been able to do that. And so I like the fact that decentralization is not just said, but it's experimented. And the simple fact that I can come and be this voice for many other players and say things out loud is already what I consider as the best proof of, in a way, decentralization. So I think we should acknowledge more on this. And I also like an expression that we had a couple of weeks ago with my team. Someone was saying like, hey, Canton is a bit like the master class of building an ecosystem, because being able to bring the small pirates that before were doing their stuff in their basement to now the same table as the TCC and top banks and Euroclear, and like that's already something that shows the ambition of the ecosystem.
Yeah, it's interesting to think about. I mean, to your point, I guess, that's what's been happening this cycle, I suppose, is kind of the Solanas, the ETHs of the world celebrate as they bring on some huge institutional giants to be using their network to maybe tokenize whatever it may be, whether it's equities or treasuries or bond funds, whatever it is. But it is interesting to kind of think about the difference, as you mentioned, the token. And I do want to bring up the token as well, because I suppose it's also worth noting that it is different in terms of how you think about maybe an ETH and the idea of, a gas token, certainly a Bitcoin in terms of cap supply and what some of that looks like. When it comes to Canton, what should people know about the tokenomics? Obviously, there are nodes being run here, and certainly, as you said, kind of trying to use something to align interests among all the different parties working to grow Canton. What's kind of like the thing to highlight around the tokenomics here?
Yeah, so that's, you raised like precisely what I think is the most powerful right now in Canton, which is their white paper and the way tokenomics were done. And kudos to the team at DA who have been building that, including like Yuval, Eric, Scholl. Like the work that was done was precisely a way to support the idea of fair launch, but not just for the people that were there, for whoever was willing to participate. Mm-hmm. And whoever you see today on the leaderboard of Canton balances, wallet balances, and all where you are able to track organization, like no one stole the assets, the Canton coin that they own. To contrary, they have been contributing to things, whether it's through infrastructure, whether it's through business and bringing people, or whether it's through asset that they brought to the chain. And basically this whole ecosystem came maybe for the tech, maybe for the reward, but in fine, they did something to get that. And if we add that more in many other ecosystem, probably we would have had a better situation today after 3, 4, 5 years, and more believers. So I like this approach a lot. Like we are called Fairmint for a reason. The word fair matters to us a lot. And I also remember when we started the company Fairmint, we were working from the IDEO Collab office in San Francisco. Close to me, I had people building Syndicate DAO, The other part of the team were releasing what was the first governance and social tokens documentation and all. So we were deep into this momentum where we were trying to reinvent things with more fair. And the fair launch idea was precisely designed to try to incentivize more the people that would be building than the people that would just bring cash up front. So I think the approach was great. The way also the way the coins kept being minted, and the way the activity, like you consume megabytes on the blockchain, you get some rewards. I mean, that approach lead to also like emphasizing who will be a good actor and who would be a bad actor would be easily excluded. But at least good actor have the feeling that they can keep building, they are supported. And that is extremely valuable. I think that a lot of people are trying also to do this type of good and goodwill in other ecosystem. And I literally applaud like whatever initiative is done on ETH, Solana and all, but we have to acknowledge that this part of this launch was pretty successful.
If there is one health unlock that you should be doing every single day, it is this Armra colostrum.
Yeah, I mean, it's important to highlight too. Obviously, there's a gamut, as I mentioned, in terms of crypto project of the year. You mentioned both ETH and Solana, both of them included this time around. ETH for the first time in crypto project of the year, and I think there's another key element here to maybe flex when we talk about exactly what you raised there in terms of not just tokenomics and the launch and the like, but also privacy being a huge, even in the ETH ecosystem now. A huge driver moving forward. I know before you and I chatted, we were talking about how that became a huge factor in how Fairmint landed and you kind of finding Canton. I want to talk about that too, because it seems like where even ETH is heading, but what's the differentiation between kind of how Canton's tackling that and maybe how the other more traditional, shall we say, crypto names may be playing catch up there?
Yeah, privacy is one of the most important part of TradFi. And if we want to bring use cases from TradFi on chain, we need to like match their expectation in terms of privacy. Canton, by its approach, you know, I like to compare it a lot with the cloud. You know, 15 years ago, you were coming with the cloud and people were extremely scared because cloud by default was public and you have a risk of losing information and that was unacceptable. So that's why at the beginning, the cloud were not ready for government or banks. But a few years after, we started to see a lot of like appliance on top of the raw cloud, and we started to have securities layer, privacy layers, and today everyone is on the cloud. There is no more question. So I think the approach and the rationale behind Canton was precisely to say, we have this use case. We have a superior technology, but because of its nature, public, permissionless, it won't be used by all those banks and all this industry of finance. How can we build something that they will effectively use? And that's the moment where you start moving from being a crypto maxi to being a consumer and customer focused and centric person. And when you hear them and you collect what they want, you are not forcing them into your permissionless crypto maxi world. You are just listening to what they need. And that has been the approach of Fairmint. We started on Ethereum then, and we were very happy to show on Etherscan the whole cap table of customers until we started to have customer complaining and telling us like, hey, I don't want anyone to know that options were exercised or that transfer was done and that the founder sold some of his shares. Like all these should have been hidden. How can we do that? And we went Ethereum L1 optimism base. We were on base layer when these discussions started to be more important. And we were also doing a Rust implementation to see if we could move to Solana.
Mm-hmm.
And that's when, those requests for privacy started to be bigger and bigger. The size of those customers being bigger, we had to find solution. And we started to look at FHE, ZK and all. But 2024, it was extremely early. Nothing was really in production. And nothing was really proven that would allow us to go back to these boards and say, hey, guys, don't worry, bring your cap table on Fairmint and the privacy will be guaranteed.
Yeah,
until
that's
I read
the interesting thing
this
too, by the way,
paper.
in terms of like timeline of all this, not to cut you off, but the idea as we were chatting with, digital asset, 2014, I think going back there, even before kind of a lot of what happened in the Ethereum ecosystem was even kind of really getting off the ground, you had them focus on what they're doing. So I think it's important to highlight maybe the differentiation in terms of exactly what you said when it comes to privacy, because, ZK versus Canton's integration. I mean, not getting too technical here, Joris, what would you say is kind of the main way to think about one road versus the other?
$15 billion is a lot of money. That's how much Lendio has helped small businesses get through our loan marketplace. If you have a business,
I think they are complementary. At one point, we'll start to see in the life cycle of an asset the potentiality of having both working. Something can be issued and leave on Canton, and at one point you have something that would require ZK. And I had this discussion with Eric at DA. Precisely because I think it's complementary. It's different approach. Both will be big, but both serve different type of use cases and customer expectations. So that's why I won't say there will be a winner. I think it's more a matter of like what type of implementation, what type of asset. And when I say that in the life cycle of an asset, you can use both, it's really because I think that when things are private by design, you want to make sure that you secure things as much as possible into a Canton style approach or architecture. When you start to deal with other type of asset or a PII or things like this, you would be more comfortable maybe to do that on a more public ecosystem with a ZK layer that guarantee that. And we are in 2026. Things are moving very fast. Like the work of ZK Sync with Previdium, the work of Zama, Aleo. I mean, all these projects and are now in more and more close to production, if not yet in production. And we see, that they will just cover the need, and those needs are extremely wide. It's a spectrum, the privacy and the security. And I think precisely we need to stop trying to always oppose two worlds like we do with permissionless or not, ZK or not ZK. I mean, at the end, it's a matter of like, what do you want to do? And listen to what the person is willing to do and come with the best solution. That's how I came to Canton, but with, for example, a clear view of the ability tomorrow to be chain agnostic in terms of like liquidity. Why? Well, because whenever we can aggregate liquidity from all ecosystem, then we are more powerful with this type of coordination of effort than by just leaning to one single ecosystem.
Well, that's where I think this starts to get interesting because, obviously, of course, Ethereum making their big push. They've got their big dog out there, Tom Lee, who, I was chatting not too long ago at Korea Blockchain Week, and he was talking about how you get to ETH 60K. Mostly how you get to ETH 60K is a lot of big institutions using the network for a lot of different transactions and a lot of assets coming on chain as well. And so, I don't know, in my mind, some of this maybe seems slightly like a zero-sum game, not fully, but also when you think about some of the announcements that have recently come out around who's working now to put those assets on Canton, I think it is important to highlight it and maybe get your take on how that trickles into the token price, perhaps, because because that's kind of the thinking, I suppose, and the ETH way of looking at things is, okay, more transactions on chain, more people needing ETH to make that happen. That's Tom Lee's main framework for how ETH gets to 60K. As far as maybe how some of this structurally maybe flows to the token, I'm just kind of succinctly wondering how I, as a journalist, might explain that to people, because these headlines are huge. I mean, DTCC is giant. I don't think there's really anyone else that rivals the size there. So talk to me maybe a little bit about that.
Yeah, so I think it's important to separate the token from the rest, in a sense that most of the tokens that are live today were the result of a community, like a more retail style community. In the context of Canton, I mean, by design and the way it started, it was not.
Do you need a loan for your business? Well, if you've been around for over a year, I'm about to show you how to get up to $3 million.
A retail project. So it wasn't funded by a broad audience of people through an ICO play, and then they go and they build. No, to contrary, it has been an approach of like very pragmatic. You are a company and you see a lot of requests from a lot of customers, institutionals, and you see the gap between what is done on permissionless ecosystem, very public one, and what your potential customer want to do. And all these years of work of listening came up as like this idea of building an open project like Canton. And so in fine, when you see that, you don't expect to have millions of people holding Canton coin right away. So you go through a fair launch and you reward the people that are building. And then all those people, by growing, like the network grow with this first people that came as well. And that's how you start to have a broader audience and a broader audience and a broader audience. So right now, what the trajectory of the token today is like a very nascent ecosystem. So it's very far from, what we see in those ICO plays. Where I'm generally like bullish is that the fact that you have all those big names, big players coming and saying, hey, not only we support, but we are dropping some of our initiatives to embrace Canton technology. The fact that I discuss sometimes with people, they use DAMO, like the smart contract. They are not even on the global synchronizer. They just use the tech because they find it's better. And you discover that this company trades billions every month of oil and gas. No one talks about them. But their team, they are expert in demo. They build their own system. It's at work for years. No noise, nothing. You don't see them on RWXYZ, right? But the volume, the activity, and all this work that is done by these people is real. And the day you will start to have this community behind this company coming, well, they won't come for the hype or for the fun. They will come because it's been maybe years now that they have been using it. Same for Fairmint. Like we have more than 18,000 investors that invested in cap tables of our private customers. All those people, they don't really care of the token until the day they realize that actually all their holdings right now are on a registry on Canton. Yeah. And that day they will realize that, oh, actually there is a true utility there. I'm using it for myself. And now I have call to action. I can sell, trade, get a loan as an employee of my stock based on my stock option. Yeah, that's the true utility. And I think that's where Canton has a lot of potential to grow, because all those people at one point will just realize that this is the tech that is part of their day. They didn't even notice.
Well, this is where we get into kind of the interesting part of this too, and maybe where it's my job to maybe play pushback on some of this too, maybe play the other side as sure. Some of these. Always, everything comes with trade-offs, by the way. Yeah. When you're building these, as a founder myself, who got Coinage off the ground as a community-owned show, also built on ETH and where our NFTs live right now. Always trade-offs. And the reason why, by the way, I think you probably agree, is like when we launched in 22, it was very unclear what's going to last, which chain you want to build on. So we went with ETH. again, maybe played out to be true. It's still here when other chains might not be. And in that sense, I guess, other full disclosure, our partners, CoinEject Stike, in terms of running validators on a bunch of different chains, have a node on Canton. Maybe speaks to, it's not just those big financial names that I mentioned, but in terms of how that maybe plays into, again, what Tom Lee says about why he's so bullish ETH is that, like, it hasn't had downtime in 10 years. You've got the decentralization in place that no one can kind of have any fair advantage here, or unfair advantage. I guess as you look forward to kind of how this grows and how this scales, push back on the critics who say Canton is not as decentralized as ETH, not core crypto ethos being displayed here. What's kind of the pushback on those criticisms?
Well, like always, it's a matter of like the glass is half full or half empty. I try to be a balanced person. So
Taxes was feeling unwelcome.
We were on Ethereum because we are true believers of Ethereum, the smart contract, and all the things that will be built on Ethereum. And I'm still genuinely believing that Ethereum can go and should go to the 60s. So whatever Tom Lee is saying, actually, I'm pretty supportive of it, and I share the same vision. The only thing is that we talk about such a massive market that the confusion comes from people trying to find their champion. They try to always have like, okay, one has to dominate and the other one cannot. I think we will start to see a diversification, and a lot of niche market will be held by one specific ecosystem that will be dominating this niche. And Canton comes with his big name, but look, these big names, they come with maybe one part of their activity. And tomorrow they will do some other activity on another ecosystem because they will see more value on this. Or simply they will try to turn Canton, and it's a bit our approach at Fairmint, into this secured private registry when the rest can live anywhere. And I think we underscore the ability for a layer like Canton to be this type of registry, and we focus sometimes too much on what's the high velocity asset on it, how much is it trading, and this velocity sometimes is not the only thing that we should monitor. We should also be extremely careful on this big move of things that are low velocity type of assets. And on this, we have a lot of things, I think, coming, news coming as well, that will comfort that. So crypto maxis, they are needed. They did a tremendous work over the last 5-10 years to make sure that crypto became more ubiquitous. And we see it with the policymaker today. There is a lot of debate, but having this level of debate is already the result of all the work that was done. So no one should complain of what he said. But we should just acknowledge we need more balance. It's a bit like in politics. You have such a polarization of the world right now that prevent us to be just balanced. And at the end, we serve customers when we build an app or that we support a project, and we should just like listen and be more careful on what are the needs than anything.
Yeah, no, I think it's a good point. And I think also, as we talk about big trends, we opened, of course, with the institutionalization of crypto, or institutions coming on chain. But the other big one, too, which I think folds into what you're doing at Fairmint as well, is just this idea of the next evolution of real world assets. We technically kind of grouped in the bracket Canton and Ondo, which is also in the kind of realm of on-chain real world assets and kind of that next evolution. Of course, everyone who's watching this will be able to vote on which projects advance to be crowned Crypto Project of the Year out of all the 16 that were nominated at coinage.media. And so that's kind of how we're trying to plan this too, is open, transparent voting, because it's not just us choosing this or anyone paying. Really, no one pays to get involved here. And so I guess in that sense, as you see, because you hinted to what's coming ahead in 2026, I mean, what is kind of the roadmap here? Because as I said, sometimes people are just kind of waking up to Canton, so they might not even know where it's come from, where it's going. But if they've now listened to all this, what should they be excited about in terms of what comes in 26?
Well, the thing also that I wasn't able to insist on with the coin, and when you compare the two approach on the Canton, like the Canton coin has intrinsic value in a sense that whatever activity that comes on chain.
This season, you've got places to go, people to see, and things to do. You may have already gotten vaccinated for flu.
Means that, and when you compare to insist on with the coin, and when you compare the two approach on the Canton, like the Canton coin has intrinsic value in a sense that whatever activity that comes on chain means that there is a lot of burn. And this burn means that you accrue value to the token. And so you end up in a situation that is literally a virtuous cycle in a sense that whatever activity that is done on the network increase the burn. And at the same time, increase the utility of the token and increase the size of the audience that Canton can reach. So the roadmap for 2026, and without disclosing what all the senior team at DA, at the foundation and all have in mind, like literally it's continuing to onboard all those big players to bring more TradFi on chain, to also, I think, be more vocal. Like I think what's really missing today is also this objectivity of what is an asset on chain. And I know that there is a lot of debate between distributed and represented and all, but at the end, like the big question is, how do you expect to represent the fact that 0.0001% of the whole TradFi market is in crypto today? Yes, the moment that you have a big IUM coming, it takes the lead of your leaderboard, and you feel pity or sad you are not anymore owning that. But yes, because this is where we are going. We want to make sure that everyone tomorrow can come on chain. So I think what we will see in 2026 is more Canton on top of leaderboard, more apps pumping up on top of leaderboard with like a lot of AUM. And yes, there will be a lot debate trying to polarize the things to avoid the real discussion, which is what can we do to make sure that we bring 100% on chain. And yeah.
Well, I think that's the interesting piece too, just because, you know, when you think about where this all heads, that is the back and forth, and I'm sure will continue to be there in 2026. Is you know where the pendulum swings in terms of decentralization and all those pieces. But I feel you, man. I mean, I would play, if I've already played devil's advocate, the other side would be what's been going well for people who were here, like degens and everything else. It's like, well, what is being promoted in those ecosystems when it comes to meme coins that are down 99% or everything else? It's like, is that any better? Really, is like that kind of where the space can continue to move? And I don't think so.
Yeah, well, DeFi was fantastic in the sense that it brought to us like a lot of new type of asset, and pushing boundaries. The second thing that was fantastic to me is that it proved that DeFi is something. And once you start to understand how to build a smart contract, how to facilitate DVP, how to do things better, and you take the other approach, like the one of Fairmint, like we are becoming a broker dealer with all the licenses. We are a transfer agent for years now, and we are able to leverage our knowledge in smart contract to bring what I like to call regulated DeFi. Then we get a chance to simply say, now we don't just trade meme coins, but we are able to trade like shares of private companies. And we are able to allow to turn those shares into collateral, so that if you are an employee that owns stocks for years or even stock options, you can leverage them to buy your house. Like very concrete use case where you go and cherry pick what works well in DeFi, and you apply it to a regulated environment. And then that's the approach where you are able to rebuild the rails. And maybe, yes, it is less permissionless than people would like, but it's regulation. And when you need a transfer agent in blockchain era, you might scream and say that the blockchain is the transfer agent. There is a law. And before that, the law will change. It will take tons of times. So what do? We wait until the bill pass, or we just like push the boundaries and try to do things and fit with the current legal framework. That has been our approach. And that's how we went from R&D during 5 years, processing 25 millions through our smart contract to, okay, now we are ready, we are TA, and we can do things better. 1.5 billion in a year. That's the volume that we've been able to process now. And my goal is to now reach the 10 billion. And so if we want to do that, we need to make sure that we are able to answer any of the question that we'll have from any chief legal officer, from any regulator, from anyone that is trying to do something. And I like also the fact that we don't have a token ourselves at Fairmint, because it makes us extremely solid when I compare to other projects that have all their equity accruing value to their shareholders, and a token that is tied to nothing. And having us building and Canton doing the job of this token, accruing to the community of people that are effectively using it, that I think is extremely powerful as well. And that's why I'm also extremely interested in what is built, and I spend and allocate time to like make sure that this foundation and the whole ecosystem at Canton is working well.
Yeah, no, I mean, I think it's been interesting to see kind of how it's all shaped up, and similar. I feel the same way in terms of it's been a tricky thing in crypto, certainly under the Gary Gensler era, of just kind of like, okay, how is this all going to work out? Where are we going to go from here? And certainly the way that we've structured things as a U.S. co-op built on chain at Coinage, I definitely hear what you're saying there in terms of sometimes not needing a token. If you're doing things the right way, as we have, we've tried to pay distributions back to our NFT holders in a legal, compliant way here in the U.S. And so I feel that. And I feel like I think the entire space is trying to wake up to different avenues and different approaches to be taken here. So I'm excited. And congratulations again on everything you built at Fairmint and what we're seeing play out now in the Canton network and the work that you've done there. It's only been since what? It was July, you said, of summer last year in terms of running things on the foundation side. So it's
yeah. Well, yeah, but like I said, the fact that during 6 months, you dig, you read the white paper, you start to chat with the people that wrote it, and they are extremely accessible and they are extremely open to critics. That's why we have all these CIP, the way we can improve the protocol and all. Like all this journey has been a journey with a lot of other people. So there is a lot of emulation, people that are trying to make things better and come with like very pragmatic feedback. And when you are able to nurture that for weeks, months, like literally every Wednesday, I'm impressed by.
Welcome back to the deep dive. If you're here, you're already looking past the noise. We are skipping the retail hype cycle, ignoring the meme coins, and going straight to where the foundational power is being built.
Right.
We're talking about the bedrock of institutional finance.
We're talking about the plumbing.
Right.
The actual infrastructure that is being purpose-built to handle assets underpinning, trillions of dollars.
Yeah.
This isn't some conceptual R&D project in a lab anymore.
Not at all.
This is where huge, systemically important players like the DTCC, like JP Morgan, and even NASDAQ, they're not just exploring white papers. They're physically building and operating the foundation for the next financial core.
Okay, let's unpack that and get really specific. This deep dive is based entirely on the 360 bag report generated by Edgen.
Right, our AI for deep market analysis.
And Edgen just cut through all the political noise, all the market chatter to give us the core unapologetic thesis on the Canton network on CC.
And the thesis is really, really clear. Canton network is a production grade settlement layer. And it's designed specifically for real-world assets, RWAs.
The big one.
The big one. So you can forget the L1 wars for a minute. This network has positioned itself as the essential infrastructure solution that actually satisfies the complex, the highly regulated demands of global institutional finance. And it's doing it right now.
And their whole mission, it seems, is to solve what has been the defining contradiction in this entire space for years.
The privacy paradox.
Privacy paradox, exactly. You have the transparency of a public blockchain, which institutions fundamentally hate.
They despise it.
Warring with the strict privacy and compliance requirements that regulators all over the world demand.
And that paradox, that's their entire value proposition. Canton's claim is that they've resolved that conflict. They've made it possible to have both granular privacy and at the same time regulatory transparency.
So the privacy paradox solved.
Or at least, functionally contained.
Yeah.
It's a workable solution for these massive players.
And this is the key differentiator for you, the listener, to track. Canton is anchoring its value not to future hype, not to some speculative story, but directly to the multi-trillion-dollar RWA market.
Right.
It's building value where the money already is, not where it hopes the money might go one day.
It's infrastructure as a service, just scaled to the demands of Wall Street. So that really sets the scene. Let's jump into section 1, institutional entrenchment and core architecture. Let's really dig into why these giants chose this specific path.
Yeah, that's the big question. Why Canton? I mean, we have dozens of enterprise blockchains out there. What made the biggest players on the planet look at this and say, okay, this is the one, this is what we build on?
It really just comes down to one thing. It's the design.
Okay.
Canton is not a general purpose blockchain. It didn't evolve from some public chain structure. And that is, I think, the first and most crucial distinction you have to make. It's a specialized infrastructure layer architected from day one as a, quote, network of networks.
So it wasn't a retrofit. It was a completely bespoke solution.
Precisely. The architecture, it operates as a series of sovereign layers. This is absolutely vital. It lets the institutions, the JP Morgans, the DTCCs, it lets them host their highly sensitive private data within their own network partition.
So their own walled garden, essentially.
A walled garden, but one with secure gates to a shared settlement layer. They can interact without exposing everything.
And this capability, it's powered by a core technology we really need to spend some time on.
However you book, first check Kayak to compare prices from hundreds of travel sites on the hotel you want. Then do what people do.
DAML. This isn't just another smart contract language, is it?
No, it's much more than that. You should think of DAML as the operating system for institutional consent and privacy on Canton. Think about, traditional smart contracts are kind of binary.
How do you mean?
Either everyone sees everything on the public ledger, or you're in a private chain where no one outside can see anything. DAML just flips that on its head. Its whole focus is granular privacy and forced integrity.
Okay, give us a practical scenario. Let's say institution A is doing a complex derivative trade with institution B. What does DAML actually do? What does it hide?
Okay, so DAML ensures that the actual participants, A and B, have absolute clarity and visibility into all the trade details. The asset type, the quantity, the counterparty risk.
The need-to-know basis.
The need to know. But crucially, the other 30 plus network validators, they can't see the asset type. They can't see the counterparty's identity. They can't see the settlement amount. All they can do is confirm that a cryptographic agreement was executed and that the transaction was computationally valid and, compliant with the network rules.
So it's true data partitioning. If I'm JP Morgan, I don't want my competitive advantage, my proprietary trading history, my client roster. I don't want that visible to NASDAQ or even to the DTCC, even if we're partners on the same network.
Of course not.
DAML gives them that fine-tuned control over what information gets revealed and, just as importantly, to who.
You've hit the nail on the head. And this design, this highly specialized approach, it addresses the fundamental roadblocks that have always sidelined public chains for these guys. Public chains prioritize universal transparency. Canton prioritizes compliant confidentiality.
And that's why they're on board.
That focus isn't academic. It's purpose-built for institutional compliance. And it's the entire reason they're here.
Okay, so that focus on privacy, it must tie directly into the network's consensus model, which sounds just as purpose-built. Tell us about this proof of stakeholder consensus.
It's a genuine innovation.
Yeah.
And it's tailored specifically for this market. In public chains like Bitcoin or Ethereum, you have thousands of anonymous validators burning huge amounts of energy just to confirm every single transaction globally. On Canton, It's radically streamlined.
How so?
Only the 2 or more parties that are directly involved in a transaction are actually required to validate that transaction.
Wait, say that again.
If institution A settles with institution B, only A and B perform the validation.
Just the buyer and the seller. That sounds incredibly efficient, but I mean, how does it maintain security if you're limiting the validator set so drastically? That seems like a risk.
It achieves security because the validators are the stakeholders themselves. This design maximizes efficiency, it reduces computational overhead to, milliseconds, but more importantly, it guarantees the strict confidentiality that DAML enforces. You only see, validate, and sign the details of transactions you are a party to.
Ah.
So it directly aligns network security and validation effort with the core economic self-interest of the institutions using it. The network's safety is literally tied to the financial health of the biggest players on the planet.
That is a phenomenal soundbite. Security is tied to self-interest. Okay, let's move to the roll call of giants because this is the operational proof. These are not speculative partners. These are systemically important financial market utilities.
The headline integration, the one that matters most, is the DTCC, the Depository Trust and Clearing Corporation.
The linchpin.
The absolute linchpin. Canton's partnership here is explicitly focused on tokenizing U.S. Treasuries, the deepest, most important capital market in the entire world.
And just to be clear for everyone, this isn't some pilot project in a sandbox environment.
No, absolutely not. The DTCC's integration signifies deep operational immersion. The project has regulatory certainty, which is critical. They went out and secured an SEC no-action letter.
Which is huge.
It's massive. It de-risks the entire adoption pathway by providing this unprecedented regulatory clearance around the whole process of tokenization and settlement. It makes the project viable for immediate real-world scale.
It's the permission slip from the highest level. But the integration I read in the report, it goes even deeper than just the technology, right?
Oh, absolutely.
Yeah.
The DPCC is so integrated into the network structure that it actually co-chairs the Canton Foundation.
Co-chairs it.
Co-chairs it alongside Euroclear. So think about that. When the financial system's primary custodian is co-chairing your network's governance body, you are well past the conceptual phase. You are the incumbent infrastructure.
That is a massive signal of non-speculative intent. They are literally helping write the rules of the road. Okay, next up, JP Morgan.
JP Morgan's integration involves JPM Coin. Now, this move enables 247 near instantaneous atomic settlements right on the Canton network. And this is a complete game changer for liquidity. Regulated stablecoin activity is the foundation for institutional DeFi, and JPM Coin positions Canton as the central hub for all of that activity.
And the market saw that. It immediately reacted to that stamp of institutional liquidity approval.
Instantly, we saw an immediate 15% price surge for the CC token the day that announcement dropped. The market recognized that this wasn't just another integration. This was plugging Canton directly into the global interbank liquidity network.
Let's look at the traditional venues, which I think shows their dual strategy. They're building the new infrastructure, but also building the connectivity back to the existing world. So NASDAQ and EDX markets.
Right. So NASDAQ has validated the network by joining as a super validator. This is crucial validation from a technology and an operations perspective. It solidifies Canton's alignment with traditional high-frequency financial systems.
They're giving the architecture a thumbs up.
They are endorsing the architecture itself, yes.
And EDX markets.
EDX is an institutional-only exchange.
Mm-hmm.
So their partnership is the bridge for the CC token itself. They provide a regulated venue for trading and settling CC, connecting the token directly to established capital markets.
So they're building the on-ramp.
They're building the on-ramp, bridging the digital asset directly into the old world framework, giving institutions a compliant way in.
They aren't just building the infrastructure, they're building the connecting roads and the on-ramps.
Build a website you love with Wix. For your words.
Okay, but the final proof is always in the scale. Let's talk adoption metrics, because in crypto, volume can be manufactured. Here, these metrics matter because they are tied to real institutional value.
Edgin's report really hammered this home. When you look at the numbers, the scale is genuinely immense and it's operational today. The network already supports over $6 trillion in on-chain assets.
$6 trillion.
$6 trillion. And we're talking about assets like bonds, repurchase agreements, repos, and various syndicated loans. Actual tangible value that traditional finance runs on. $6 trillion. I mean, just to give that some perspective, that is roughly the combined annual GDP of France, Germany, and the UK. That size of assets is already being managed on this nascent technology. It's staggering.
It is, and the activity validates the usage. Daily transactions are already exceeding 800,000. This is not a concept. It is a scaled functional system. And what's more telling is the acceleration. That volume represents a greater than 33% increase just since October of 2025.
So it's growing fast.
It is accelerating fast because more and more institutions are plugging in.
But the number that really, I think, defines the operational reality is the repo market volume.
Absolutely. Broadridge's DLR platform, which is critical in U.S. Treasury repo trades, is processing over $280 billion in daily repo trades on Canton alone. The network's total daily financial flow is hovering right around $350 billion.
Okay, let's just pause and let that number sink in. $350 billion in daily flow. That's why we say Canton has de-risked its adoption pathway. This is not a concept. It's not a test net. It's operational.
It's live.
It's handling hundreds of billions in daily financial flows right now, proving its capacity and its compliance credentials. They've basically established themselves as the incumbent infrastructure before most of the public even knows their name.
And that is the core takeaway from this first section. They chose to prioritize deep, meaningful engagement with systemically important players over broad retail mindshare. And the operational metrics, $6 trillion in custody, $350 billion in daily flow, they confirm that that strategy worked perfectly.
Perfect. That leads us directly into section 2. We stop talking about infrastructure and we start talking about the economics. We have to discuss the single most important bullish insight, this idea of utility-driven scarcity.
This section is where we analyze the tokenomics, which is really where the value proposition for the asset itself lies. And the core thesis shift here is crucial to understand. Canton has successfully transitioned from being a promising white paper concept to being proven production-grade infrastructure. Therefore, its value is now anchored to utility, not some speculative narrative. It's tied directly to those hundreds of billions in daily transactions we just talked about.
And that utility is baked directly into the tokenomics model. We're talking about the burn and mint equilibrium, or BME. Walk us through the full cycle of the BME model, because it is, I have to say, it's elegant and it seems highly effective.
The BME model is designed to create a direct, unassailable link between real-world network usage and the value of the token. And it has two key levers.
Let's start with the demand side, the driver, the engine of value creation.
That's the burn mechanism. So institutions pay transaction fees, but, and this is vital, they are denominated and paid in US dollars.
Which is key for TradFi. They don't want crypto price volatility in their operations budget.
Not at all. They want predictability.
Okay, so they pay in dollars, which is comfortable for them. But then how does the actual token get burned?
The network takes that USD fee, and then it uses that fee to algorithmically determine and immediately destroy an equivalent value of CC from the existing supply. This creates immediate, unavoidable deflationary pressure that is tied directly to the usage of the network. That $350 billion in daily flow we just discussed.
So just to be crystal clear, when Broadridge is doing its $280 billion in daily repo trades, real dollars are being paid in fees and an equivalent amount of CC is permanently removed from the supply. That's why we're seeing daily fee burning already at what, $1.2 million?
$1.2 million a day.
That is a serious, tangible deflationary force. It's not a theoretical one.
And that burn rate is compounding as adoption accelerates. So now for the other side of the equation, the incentive driver, the mint mechanism. New CC is minted, but it's done under highly controlled circumstances.
Okay, so how does that issuance work?
It's what they call the earned issuance model. New CC is minted exclusively as rewards for infrastructure operators, so the validators and application builders. It's designed to incentivize two things: security through validation and growth through application development.
Active participation.
It rewards active participation and contribution, not just passive holding.
So the equation is pretty simple then. Utility drives the burn drives scarcity, and this controlled minting drives security and growth.
Precisely. And that brings us to the data point that, for me, is the ultimate signal of network health and fundamental maturity. Edgen highlighted the burn to mint ratio.
And this metric is the single most important number you need to be tracking. It tracks whether usage...
Taxes was feeling unwelcome. Now Taxes is an open door to new TurboTax store.
The burn is outpacing issuance, the mint. At launch, this network was like most new projects.
Yeah, at launch, the ratio was negligible. It was 0.025. So that means for every 1 token minted to reward validators and builders, only 0.025 tokens were being burned through transaction fees. Issuance was massively outpacing demand.
It was inflationary, which is typical for a new network.
Yeah.
But by the fourth quarter of 2025,
that ratio had surged to nearly 3.0.
3.
That represents a 120-fold increase in the efficiency of its tokenomics.
That is the single most important bullish insight, a 3-to-1 ratio. It means that tokens being burned from real-world, highly valuable institutional usage are substantially outpacing the new issuance meant for reward pools. This isn't speculative mania driving this. This is economic reality.
It's the engine running hot. The network is fundamentally deflating based on demand generated by $6 trillion in assets and $350 billion in daily flow. This is the proof that utility drives scarcity. It is a sign of maturity that, it resembles layer 1 protocols like Ethereum post-merge, where the economic output of the network itself creates the value, not just the promise of future utility. You can bet on the math, not just the narrative.
And speaking of maturity, we have to talk about the supply dynamics. Because in most crypto projects, the threat of massive future unlocks from VCs or the team creates this permanent supply overhang that just crushes any upward price action.
And that risk is functionally eliminated here. This is crucial fact number 2 from the report. There was no pre-mine, no VC allocation, and no team pre-sale. All the tokens that are currently in circulation were earned through network participation. The supply entered the market organically.
Which means the market capitalization and the fully diluted value, the FDV, they've effectively converged at the current valuation, which is roughly $4.86 billion.
And that convergence is absolutely key for institutional confidence. It removes that existential risk of future dilution or these massive token unlocks that would suppress the price. The price is now free to move based purely on the BME dynamics and the success of their execution.
And we saw a governance shift just this month, January 2026, that seems to reinforce this commitment to growth over just passive rewards.
Yeah, they executed an 80% cut in rewards for super validators. And that capital wasn't just pocketed. It was reallocated directly to the developer application fund. This signals a really clear priority shift from passively rewarding network security to aggressively funding growth and application building. They're prioritizing accelerating utility creation over just maintaining high returns for the early stakeholders.
So to sum up section 2, the foundation is built, the giants are using it, and the tokenomics are actively deflationary based on that real world usage. That makes an incredibly strong fundamental case. Now let's flip the script.
We have to.
And move to section 3. The bearish risk and surprising contradictions. We have to encourage critical thinking here.
Absolutely. The investment thesis is powerful because of the adoption, but that adoption comes with a high degree of what you call contingent risk. The single most important bearish risk facing Canton right now is execution dependency.
Okay, that sounds simple, but what does it mean in practice for a network this complex?
It means the entire bullish narrative that we just laid out is heavily contingent on flawless and timely execution of their key roadmap items. There is zero tolerance for error or delay. They have the partnerships, they have the regulatory approval, they have the architecture. Now they have to make the train run on time.
And the primary highest stakes catalyst that we're all waiting for.
It's the DTCC US Treasury MVP launch. It's slated for the first half of 2026. This isn't just a technical rollout. This is a global test of their credibility. They have the SEC letter, they have the architecture, they have the partnership. Now they absolutely must deliver on the operational rollout of tokenizing the most important asset class in the world.
So what happens if that launch fails? Or even if there's a significant technical delay, say a few months, what's the consequence?
It would be devastating. It would completely squander their first mover advantage. The competitive environment right now is just too intense. The market is not forgiving of delays when a multi-trillion-dollar assets are waiting in the wings. A technical fumble at the starting line is the biggest single risk facing this asset. It would destroy confidence in their ability to handle mission-critical financial infrastructure.
And here's where it gets really interesting for me, because we see this structural contradiction. Let's talk about the surprising or contrarian takeaway, the centralization paradox.
This is truly fascinating, and it's a trade-off they knowingly made for adoption. What makes traditional finance comfortable enough to actually use Canton is precisely what worries purists in the decentralized space.
Remind us of the governance structure again.
Governance is heavily influenced by a pretty small group, just over 30 super validators. But more importantly, the Canton Foundation, the main governing body, is co-chaired by financial titans, the DTCC and Euroclear.
Okay, so I have to ask the difficult question. If the DTCC and Euroclear are co-chairing the foundation, doesn't that mean they can essentially veto any proposal that might benefit broader decentralization, but, hurts their institutional comfort or their competitive position? How is that not a terminal risk in the long run?
That concentration of power is, by definition, a long-term structural risk for the decentralized ethos. It is not true public governance. However, and this is the key, you have to view this risk through the lens of necessity. This centralization is precisely what makes traditional finance comfortable enough to adopt it at scale.
It's a necessary evil.
It is.
TradFi operates in a world of accountability. They want a visible, regulated throat to choke if something goes wrong. They want named institutional partners making the final security and governance decisions. So they happily trade the decentralized ideal for regulatory comfort and security.
It was a brilliant, highly strategic trade-off they made for market penetration. They got the $6 trillion in custody because they were willing to centralize. But we have to acknowledge that if the network ever evolves beyond the needs of its initial giants, that concentrated governance structure could become a barrier to broader innovation and competition from true public DLTs.
And that leads us directly into the competitive landscape. Because while Canton has this amazing first mover advantage, we know competition is mobilizing very quickly. The competitive squeeze is intense right now, specifically Q1 and H1 of 2026.
This is a battleground moment. Canton's direct enterprise competitor, R3's Corda protocol, is set to launch on the Solana network during the first half of this year. This is a massive threat.
Why is Corda on Solana such a threat? I mean, Corda is already a known quantity in TradFi.
Exactly. R3 Corda is a familiar enterprise-focused name with an established user base. By moving on to Solana, they combine that enterprise familiarity with the speed, the low cost, and the proven scalability of a major public layer 1. This directly targets Canton's speed and reliability niche.
So they're offering an established alternative on a high-speed engine.
A very high-speed engine.
And it's not just Corda. There are two other established players that are attacking Canton's core technical moat, that granular privacy.
Right. Ripple and Chainlink, both established players in the institutional crypto space, are rolling out institutional-grade privacy features in Q1 of 2026. They are specifically upgrading their tech stacks to challenge Canton's unique selling proposition of Dample's granular control.
How does their privacy offering compare to Damel's sovereign data partitioning?
Generally, they're leveraging zero-knowledge technology or specific sidechain encryption mechanisms. And while they might not offer the same degree of sovereign data control as Canton's multi-network structure, they do offer established liquidity, existing connectivity, and proven track records.
Right.
Canton must execute that DTCC MVP launch flawlessly to fortify its moat before these powerful competitors can scale up their alternative solutions.
Finally, let's address a hidden but potent risk that Edgen spotted in the on-chain data: latent volatility that stems from bridged concentration.
This is a detail that needs to be analyzed really carefully, especially for anyone participating in the secondary markets. A single wallet holds a staggering 68.18% of the bridged CC supply on the Polygon network.
Wow. Nearly 70% of the secondary market supply is in one single place. That is highly centralized.
It creates two massive issues. First, it's a narrative vulnerability. It just undermines the perceived distribution of the asset. And second, much more practically, it poses a latent risk of high volatility or price suppression on those secondary markets.
So if that one entity decided to offload even, say, 10% of that supply into the Polygon DeFi ecosystem, what happens to the short-term liquidity and the price of CC on those markets?
The short-term price action would be violent. Liquidity on the decentralized exchanges would just be overwhelmed. It would cause massive slippage and price crashes. This hidden centralization point means that while the core CAN network is protected by its institutional usage, the secondary market price is uniquely vulnerable to a singular, potentially malicious, or even just a reckless actor. You have to factor that into any trading strategy.
Okay. We've covered the architecture, the massive utility, the deflationary tokenomics, and now the serious execution and structural risks. Let's pivot to section 4, market dynamics and the clear implications for you, the learner. What does this all mean for someone watching the asset right now?
Okay, so as of January 15th, 2026, CC is trading at around 13 cents. It's in the middle of a short-term correction, down about 8.71% in the last 24 hours. But you have to remember, this follows a historic monthly surge of nearly 100%.
Right, so a healthy pullback after a massive run-up. Why the cooling off period?
Analysts are attributing this to the classic combination of profit-taking after that rapid ascent and critically market rotation. We saw significant capital flowing specifically into Bitcoin and some of the other major layer ones at the start of the year. The fundamentals of Canton haven't changed, but the short-term market psychology has caused a necessary consolidation.
Let's talk technical benchmarks then, because TA can help us map out the demand zones. Where is the key support area that the market really needs to hold?
The key support zone traders are laser focused on is between 10 and 11 cents. The 30-day simple moving average, which is a crucial momentum indicator, is sitting right at 0.1175 flens. That just reinforces that zone as a strong historical level of demand. If the price holds there, it suggests this consolidation is healthy and the upward momentum hasn't been broken.
And what about the resistance level to beat, the psychological barrier?
That is 17.5 cents. That's the level where profit-taking previously kicked in and aggressive selling pressure appeared. Breaking and holding above that level suggests a new bullish phase, which would likely be triggered by a positive news catalyst.
And the momentum indicators, they still look pretty good, right? The asset isn't overextended.
Not at all. The relative strength index, the RSI, is currently at 58.1, and that confirms the asset is not in overbought territory. Despite that huge surge, it retains significant upside potential without the immediate threat of a major technical correction. The runway is still clear for future expansion, provided those fundamental catalysts arrive.
Now, here is the most interesting wrinkle in the market dynamics right now, and it defines the immediate term volatility risk. Derivative sentiment. There is massive speculative interest. Open interest surged 67% to over $40 million.
Momentum, acceleration, embrace the pursuit. David Yurman Chevron Collection.
But the sentiment among the top high-volume traders is incredibly cautious.
And this is the perfect setup for maximum volatility. Despite the underlying $6 trillion in utility, Edgen's data shows that 65% of top Binance traders are holding short positions. They're actively betting against an immediate bullish continuation.
So they are essentially betting on the bearish risk that we talked about. They're betting on the failure of the DTCC to execute successfully in H1 2026, or maybe the success of Corda or Chainlink stealing that market share.
Exactly. They're betting on execution risk or competitive pressure winning out over the current utility. And this creates one of the most exciting potential market scenarios we've seen in a while.
The dreaded, or for some, desired short squeeze potential.
If that DTCC launch in the first half of this year is successful, that massive short position acts like rocket fuel. A successful launch accelerates any bullish move because all of those short sellers have to buy back CC to cover their positions,
creating a huge demand shock.
A sudden, violent, upward demand shock. This is how assets move from a healthy increase to a truly parabolic surge.
So the immediate term market structure is basically defined by a high-stakes binary bet on institutional execution. The whole market is just waiting for the starting gun.
It is. Now, let's ground all this in valuation versus utility, because the numbers suggest the market is still catching up to the fundamental value being generated here.
Right. It secures $6 trillion in assets, yet its price to TVL ratio was only 0.01x back in November of 2025.
And that ratio tells you the market has not fully priced in the value of the assets it manages or the value of the compliance and security it provides for those assets. It's a historically conservative valuation, which demonstrates that the market is valuing the token based on current operational use and proven utility, not speculative future dreams.
And Edgen's valuation scenarios seem to confirm this resilience. The base case scenario, which Edgen assigns a 45% probability, assumes strong execution even in unfavorable markets. And it projects an FDV of $4 to $5 billion.
That is highly significant. It confirms that the network's fundamental value generation ability is independent of general crypto market hype.
So utility drives the price floor.
Exactly. The massive upside, the $12 to $17.5 billion bull case, that relies entirely on both strong execution and a favorable overall crypto market.
Yeah.
But that base case shows fundamental resilience.
Okay, so what are the clear implications for investors or traders? What are the 4 key actionable signposts they should be monitoring actively right now?
You need to be hyper-focused on these 4 catalysts.
Signpost 1, the biggest one.
DTCCC MVP launch. This is the core thesis validator. Success means the fundamentals are proven, compliance is met, and that short squeeze potential gets triggered. A delay or a failure is the single biggest red flag that suggests the execution risk has materialized.
Signpost 2, which speaks to the health of the tokenomics engine.
The burn to mint ratio. You have to track this metric weekly. It must sustain a level above 1.0. If you see that ratio accelerate after the Q1 2026 Fusion network upgrade, which enhances smart contract capabilities, that will confirm accelerating utility-driven deflation. If that ratio drops back down toward 1.0 or below, it suggests that new issuance is starting to outpace adoption. The engine is slowing down.
Signpost 3 is about network effects and the broadening of adoption.
Watch for new high-caliber institutional announcements. We saw how the market reacted to JPM coin. Watch for similar names. Major central banks, sovereign wealth funds, other systemically important super validators joining the foundation or launching applications. This will signal that the network effects are broadening, not just stagnating with the initial set of partners.
And finally, signpost 4, the external pressure.
Monitor the competitors. Closely observe R3 Corda's market traction on Solana. Watch the rollout of institutional privacy features from Ripple and Chainlink in the first half of the year. Are they signing new enterprise clients? Is their tech proving more appealing to specific niche institutions? That's how you gauge the pressure on Canton's unique but narrow position.
This has been a true deep dive, drilling down from 6 trillion in assets to a single technical ratio. Let's wrap it up with a quick summary.
Canton is a foundational investment in the future of institutional finance. The utility is exceptionally high, the tokenomics are robustly deflationary, but the entire upside potential is currently locked behind execution risk. It is a fundamental play with high technical volatility.
And a recap of the 3 key takeaways we discovered today. The bullish insight is that BME model and that sustained burn to mint ratio near 3.0. Utility drives scarcity, period.
The bearish risk is the total dependency on the timely, flawless execution of that DTCC MVP launch in the first half of 2026. Everything hinges on that delivery.
And the surprising takeaway is the centralization paradox. That necessary concentration of power DTCC and Euroclear
family and close advisors as it pertains to their involvement in crypto. There's a lot of questions about DeFi and how and whether it will be sort of regulated under this legislation. And the really big one relates to stablecoins and yield, because something that came out of the Genius Act was some very clever ways for stablecoin issuers and companies associated with the stablecoin ecosystem to sort of indirectly provide yield, which, at least according to the banking lobby and I guess some of the senators who helped draft the Genius Act and bring it to law last year, is against the spirit of what was intended. And the banking lobby in particular wants to close that this time around and sort of have a bit of a redo when it comes to the Genius. So I know you're not a DC lobbyist. I know you're not a policy insider, but it's been impossible to ignore the story. So I just want to briefly start off by getting your reaction to what happened.
Yeah. Thanks, Steve. A very intense week for the crypto policy community and all the legislators and staffers working on this topic. Look, taking a step back, we see a very encouraging trend on regulatory clarity for the crypto industry here in the United States. President Trump came into the office with a mandate from voters to work on these topics, and we've made huge strides. The Genius Act that you mentioned, all the changes from the SEC and other agencies last year, including things that are quite central for an asset manager like Grayscale, generic listing standards for exchange-traded products, for example. So we've made huge strides, and those are going to continue regardless of what happens on the market structure bill. We're going to see more progress from the SEC, for example, this year, more ETF product launches. So to me, the trend is very positive. That being said, this piece of legislation is quite important. There's lots of different types of crypto industry players, and they have different interests in the legislation. Grayscale is an investments business. We're helping investors get access to crypto assets safely and securely and build them into diversified portfolios. So those are the things that matter most for us for this legislation. And what that means is really the Section 1, Title 1 of this piece is the most important for Grayscale, and that's clarifying the commodity and security status of tokens in the market. That's what's most important for investments business like us. So we're pretty happy with how that piece of legislation works. I agree with all the industry players on some of the other important issues, the protections on DeFi, the need for stablecoin yields. We're focused on really that first section, regulatory clarity on the assets that are in the market today, which will allow issuance of these assets to pick up. And that's great for investors, the clients that we service. So that's really the kind of the Grayscale perspective. We're happy with how Title 1 of the legislation looks, and we're going to let some of the other industry players battle on some of these other important topics.
Yeah, it seems like this is one area. I mean, after Grayscale had been in the news for years and years, fighting with the SEC to convert GBTC to an ETF, et cetera. I guess maybe it's a little nice that you guys not necessarily are sitting on the sidelines, but you're not quite the central player in this particular fight.
And we'll let people battle those fights today. We're very happy to see regulatory clarity coming for the industry, broadly speaking, and it feels like it's happening at a very rapid pace from our standpoint, from the standpoint of an ETF, crypto ETF issuer. So things are moving in a good direction. These are all important issues. DeFi protection, stablecoin yield, very important issues, but we're letting other players take the lead in those negotiations.
Right. I mean, you've gotten clarity on staking, so you're allowing that first amendment ETFs, and I guess it's really more just, I don't know if accounting was the right term, but if you're going to file new products under the 33 Act or the 40 Act and some of that type of stuff. I know you offer some DeFi products, and theoretically, like depending on treatment of DeFi and adoption, that could have associated impacts on demand for that type of product, but I get it.
Absolutely.
That said, I mean, you've got decades of experience in finance and in particular in Wall Street. So I really want to get your sense of like what's going on at banks. Like what is your sense there? Because it's hard. The stablecoin yield, I mean, that's a big discussion, although there is a bit of dichotomy between like for instance, B of A and JP Morgan. I mean, some are more cautious or concerned about stablecoin yield sucking out deposits and liquidity versus others. There's accusations that these big banks are hiding behind community banks to sort of protect their own turf. And all of this comes within the context of President Trump, I guess, trying to mandate a 10% cap on credit card fees, which could really be devastating for bank credit card issuers, their finances, or really restrict credit in the ecosystem if they can't service certain communities profitably. So that's the bigger context. I mean, what do you see there from the bank's perspective?
Well, a lot of moving pieces. You know, on the narrow issue of institutions, traditional banks, investment banks, broker dealers engaging with crypto. Look, what we see is everybody is building, and nobody is going to wait until President Trump's signature hits the legislation to begin building in the space. There's lots of competitive dynamics at play. If you wait until the legislation is done to begin kind of planning and investing, you're going to be behind your competitors. So all these big institutions have been engaged with crypto in various different ways, really for the last couple of years. And that process is accelerating as the signature hits the legislation to begin building in the space. There's lots of competitive dynamics at play. If you wait until the legislation is done to begin kind of planning and investing, you're going to be behind your competitors. So all these big institutions have been engaged with crypto in various different ways, really for the last couple of years. And that process is accelerating as the regulatory rulebook is getting more clear. So what are we going to see? I think the things that the visible things that people are going to start to see this year are, first, stable coins showing up in lots of different places. Stable coins on corporate balance sheets in their official SEC filings. Stable coins as collateral on big derivatives exchanges. These are going to be some of the big visible things that you see Wall Street banks doing. And then you're going to start to see, I think probably after the market structure bill gets laid down, banks engaging with blockchains directly, interacting with their own wallets, directly holding crypto assets on balance sheet and engaging with the blockchains. And then the kind of last piece, and the thing maybe that I'm most excited about following this regulation, is issuance. You look at big companies, they have lots of different ways to finance their business or ways to optimize their capital structure. They issue stocks, bonds, hybrid instruments like convertibles and preferred stocks. In the not too distant future, our view is that they will also be issuing tokens, crypto tokens, blockchain-based tokens as a part of their capital structure. And regulatory clarity is going to allow that to continue. Mm-hmm. So I think an explosion of issuance from large businesses of tokens as a natural part of the capital structure is going to be one of the biggest implications of regulatory clarity in this space. So lots going on, but in my view, issuance will be the most long-lasting and probably has the biggest implication for investors, the clients that we service at Grayscale.
Yeah. So just to follow up on that, and then we'll move to markets, which is, I know, your real area of expertise. Who do you think has the most to gain or lose from all of this? Like who's going to benefit the most? And I guess the answer could be a little bit depends on how the final bill, if there is a final bill, how it's constructed, but who's got the most at stake here?
Yeah, look, when we look at decentralized finance, right, I think that the bigger picture vision is that we're going to compete with all aspects of traditional finance, all aspects of trading, lending, payments, custody. We're going after all of those things. But decentralized finance excels at a couple specific things today. And these are things like cross-border payments, mm-hmm. trading of crypto native, and collateralized lending. So focus on those issues. I would think those are the things that are most at threat from continued growth in the crypto ecosystem. The decentralized finance is cross-border payments, trading of crypto native assets, and collateralized lending. The parts of the large banks large financial institutions that engage in those businesses, we're going to go after first. And eventually, many other things, trading of equity securities and bonds, uncollateralized lending. We'll get to all of those things, but I think those are sort of next generation DeFi. Today, I would focus on those specific pockets. The banks are very well aware that their margins in those business are the things that are a threat from DeFi. And so, they are preparing, either investing in stable coins or other infrastructure so they can hold back the industry or at least compete alongside it as DeFi continues to grow.
Gotcha. Okay, so let's turn to the markets. I mean, it seems like Bitcoin, ETH, and a bunch of alts are, I guess, I don't know if ignoring is the right word, but they're certainly taking some of this turmoil in stride. I mean, Bitcoin briefly touched, I think, $97,000 last year, the first time in months. It's up 10% on the year. It's dragging a bunch of other tokens along with it. I mean, the rally really seemed to start a little bit with everything that happened with Jerome Powell and I guess U.S. Attorney Pirro over Sunday night, and I guess concerns about an increase in easy money, et cetera. But these assets are jumping, and I'd love to really kind of understand, because you go very deep into the data, why. And the real question, I guess the real two questions then on people's minds are, one, how sustainable is it? And two, how high could we go?
Yeah, lots to dig into. And I think maybe we could separate the kind of fundamentals and the fund flow topics and technical topics. As you mentioned, Steve, we look at both of those things at Grayscale. You have to look at both of those things to understand why any asset moves in the market. Definitely Bitcoin and Ether, that's the case. Maybe just starting briefly from the fundamental side of things. Look, I think the regulatory clarity piece is an important piece of it. But as you say, as the kind of odds of this legislation are moving back and forth, it's not directly translating into markets right away. I think that's partly because people still think this legislation is going to get done. But I think the bigger piece of it is that the number one driver of capital flowing into crypto is demand for alternative stores of value. It's this macro imbalances that are driving capital into foreign currencies, into precious metals, into industrial metals. These are the same forces that are driving capital into crypto. And to me, that story keeps getting bigger and bigger. And you can look at things like gold, silver, platinum, palladium, everything that is happening in the precious metals. Clearly, debasement trade still running there. And I think basically the debasement trade has arrived in crypto in the last couple of days. So that's from a fundamental perspective.
And that's overriding any of sort of like the endogenous things that are happening in crypto right now.
Yeah, I would say maybe if I had to put a kind of rough number on it, I'd say it's sort of 70-30, 70% the kind of macro trade, dollar debasement trade, and 30% the regulatory trade. Again, like just to roughly approximate my own thinking. And then the fund flows are very interesting. There's always a lot of moving pieces, but I think primarily the driver at the moment is the ETFs or ETPs, exchange traded products. We use those terms synonymously. In December and in the very beginning part of the year, it was all about kind of a tax related trade. You had $1 billion come out of the Bitcoin ETFs in December, and $1 billion come right back in the first 2 trading days of this year. That's a sign that probably there's people realizing tax losses in the 2025 tax year and then buying back those positions at the start of the following year. I don't think it suggested anything fundamental. And then in the last few days, you've started to see some of those real longer-term fundamental capital flows come back into the ETFs. And that's really the flow story. Why price is up is the ETFs have come to life again. And that's what we want to see. That's what we'd expect to see. The ETFs are the natural place for institutions, for intermediated wealth to access crypto. We're starting to see that now. And I think it's driven by both the macro story, a demand for alternative stores of value, and to some degree, improved regulatory clarity. And happy to dig into the other types of flows, derivatives, and some of the whales, some of the big stories from Q4. But I think it's the ETFs that have been the big mover since the start of January.
Great, and we will get into that stuff. But I do want to ask you about just at least flows for your ETF. I know sometimes it's hard to know exactly who's buying your stocks or who's trading them, but I am curious, like your sense, are these big institutions, is this retail? Are these flows coming from RIAs that have mandates now to offer these products to their customers? Like what's your sense of actually who's buying it? Because I have seen a lot of reporting and data suggesting that this time it is largely a retail-driven, spot-driven sort of surge in demand, at least for now. Derivatives volumes and open interest remain somewhat flat. And I think even the Bitcoin funding rate I saw was negative. So it seems like it's really a spot movement. And I'm curious like how that correlates to what you're seeing, at least when it comes to GBTC and broader ETF flows, which I'm sure you track.
Yeah, absolutely. crypto derivatives markets, especially that offshore market dominated by perpetual futures, is still pretty quiet. We can talk about that more at length. It really has not been a re-leveraging of offshore futures market driving prices recently. It's been real money or fiat currency being converted into Bitcoin through the ETFs coming into the market. And who is the buyer? You mentioned that there's lots of different types of buyers. There's retail, there's traditional institutions like pension and endowments. But the big piece in the middle of the bell curve for the ETFs is advised wealth. And this is RIAs, as you mentioned, independent wealth advisors, but also increasingly the broader platforms are onboarding our products and other crypto ETFs, and advisors are building them in to diversified portfolios for their clients. We think that this has a very long way to go. So our data would suggest that conservatively, there is less than 0.5% of U.S. advised wealth allocated to the crypto asset class. And I would say it's probably even quite a bit smaller than that, but conservatively less than 0.5%. That number probably grows to a few percent
Actually,
coming years.
And if I could interject, apologize if you don't have the number off the top of your head, but what is 0.5% of advised wealth? Like what does it actually mean to make it tangible for
It's like a couple $100 billion, $100 billion, something like that. U.S. advised wealth is probably a $40 trillion or so industry. There's no exact precise number, but 45 trillion in that ballpark. So you have a lot of money that has moved into the crypto ETFs, of course, over time. Also into digital asset treasuries like Strategy or MicroStrategy. And we count all of those things together. When you look at the portion that's held by advised wealth, again, all added up, we still think that is a good deal less than 0.5%. And so when we look over the coming years, Grayscale, we'll focus on all those different investors, institutions, retail, but advised wealth will be a huge piece of it. I think that this will be a very steady source of demand for capital inflow into the ETFs and something that will create a persistent bid for Bitcoin, for Ether, for some other altcoins over time.
Yeah, I think so too. I mean, I'm going to try to do a little math in my head, and it might not be a good idea because I actually made some mistakes helping my fourth grader with their math homework last night. But I think JP Morgan came out with a report saying that there was about $150 billion of inflows last year into crypto. Does that sound about right to you?
A bit less than that. I mean, if you look at the net flows for all crypto ETFs, just the ETFs, and maybe
not just ETFs. I mean, I think you're talking about treasury.
With the debts, probably it reaches that number. Yes.
Yeah. So so I'm just thinking like a couple $100 billion in advisor denominated funds. Like it would be much less than. Well, I messed up. I think doing math again, but it's much less than 0.5%. It seems
correct.
So I'll stop trying to do that. All right. We have a lot more to get to, but we need to take one more break so we can hear from the sponsors who make the show possible.
Before we built Walrus, what we heard a lot from developers was the need for speed, and we had it ourselves. So reads and writes are extremely fast on Walrus, and this means that apps don't lag even with really large files. Privacy was another thing that we heard a lot about, and Walrus lets developers encrypt data with our primitive called Seal. And with that, you have full control over who accesses your data, and everything is enforced on-chain. And this enables these really incredible use cases that haven't been possible before. Everything from more reliable AI models to data markets where users can monetize their data. So if you put this all together, what this actually means is the developers can finally build apps and they feel Web 2 fast, but you've got Web 3 level guarantees.
All right. So let's pick up where we left off. The real question now, I mean, it seems like some of the fundamentals are much more encouraging than perhaps other brief rallies. And the real question now is what happens next? Bitcoin, like $100,000. We haven't gotten there yet, but that's a very psychologically significant price point. Typically, when Bitcoin has these surges, the long-term holders are selling. Although I've seen some data suggesting that those sales have slowed down and profit taking may not be as robust this time around. But what are you seeing? Like, do you see the potential for a breakout back into six figures? What would it take?
Such a great view. Thanks for coming. My pleasure. So I guess I'll just jump right into it. So I think the first thing that we're all wondering is what is really driving the growth of the RWA industry, and how much of that growth is stables versus everything else that isn't a stable. So Stani, how do you think about that?
Yeah, I mean, stable coins are kind of like the ultimate RWA in the same category in the sense that you have some sort of value that is in the real world, that is tokenized and used on chain. Obviously, the big difference between stablecoins and the RWAs or these other off-chain assets that